Welcome to the Corporate Director Podcast, where we discuss the experiences and ideas behind what's working in corporate board governance in our digital tech-fueled world. Here, you'll discover new insights from corporate leaders and governance researchers with compelling stories about corporate governance, strategy, board culture, risk management, digital transformation, and more.
Hi, everybody, and welcome back to the Corporate Director Podcast, the voice of modern governance. My name is Dottie Schindlinger, Executive Director of the Diligent Institute, and I'm joined once again by my amazing co-host, Megan Day, Principal Solution Designer at Diligent. Megan, how are you doing today?
Hey, Dottie, or should I say MC extraordinaire of this year's Elevate conference.
Yeah, I don't know if everybody can hear. My voice is a little lower than it normally is. Ooh, hello. And that's because I've been the MC up on the main stage at our Elevate conference, which just wrapped up yesterday. Megan, what'd you think? What were some of the sessions that you got a chance to attend?
Oh my gosh, I loved Elevate this year. I mean, aside from, the big splashy main stage sessions, hello, Aaron Brockovich, amazing. I really spent all of my time in the risk track, which has become my new favorite thing here at Diligent. Learning more about enterprise risk management, how different functions inside organizations are thinking about risk management, be it the general counsel's office, be it the audit team, really interesting stuff.
Yeah, I have to agree, Megan. I mean, there were some really spectacular sessions, some real standouts for me. I think, well, first of all, very near and dear to my heart was the Elevate Leadership Summit, which we ran on Monday. And I say that because, I really had a big hand in helping to figure out what needed to happen during that day. But we had about 70 people in the room, all of them either corporate directors or C-suite executives of companies, a lot of them actually from the Houston area, which was great. And we had 4 panel sessions on key areas of risk. So the first one was a tag team of Anastasia Lauterbach and Pav Gill, who were 2 of the people that worked from the inside of Wirecard to bring the financial fraud and abuse to light, and have since been doing everything they can to try to make sure people understand what really happened and, kind of make sure that those that committed crimes go to jail, which is pretty impressive. Then we went next to talking about generative AI. And I was excited to have a panel of people who really are on the front lines of generative AI. We had Keith Enright, who's the Chief Privacy Officer at Google, Sophia Velastegui, who's the AI advisor to the White House. She was formerly the Chief AI Officer at Microsoft and has worked a number of different places. We had Florin Rotar, who's the Chief AI Officer for a joint venture called Avanade, which is joint venture between Accenture and Microsoft. And we had the incredible Dominique Shelton-Leipzig from Mayer Brown, the author of a book called Trust, which is phenomenal, as the moderator. So it was just a phenomenal lineup. We went right from there into a conversation about cybersecurity. We had Keith Enright and Dominique join that panel as well. And they were joined by Suja Chandrasekaran, who's an incredible director, Lisa Edwards, our own executive chair, who, by the way, just finished her master's program in cybersecurity and policy, which was great. And Jim Alcove, who's the former Chief Trust Officer at Salesforce, now has his own venture called Illyria, which is really all about redefining how we handle identity. I think you've heard him on the podcast here recently. So that was an incredible conversation as well. And then finally, we ended the 4-part series on geopolitics. And there we were really grateful to be joined by Anna Dutra, who's been a guest on the show. She's a incredible director on many multinational companies, and she interviewed Nicholas Snyder, who's the director of the Office of Japanese Affairs for the U.S. State Department, but he spent the last 30 years of his career in the APAC region. And so talking to him about geopolitics gave the directors and the C-suite leaders in the room a very clear picture of the China-Taiwan situation, kind of how to work with the State Department, what are the ways that business and government need to be partnering together on things like supply chain risk and other issues related to geopolitics. It was just kind of an amazing day. And so we had that session, incredible conversations ensued. The really cool thing is the Institute will be writing a paper about what we learned on that day. We had great conversations all across the day. And while it was all Chatham House rule, we're going to, write a high-level paper that shares some of the key takeaways. And we'll be delighted to share more information about that when it's published.
Love that. It really was a tremendous day and really a tremendous couple of days. And check out the Diligent website for sure too. Lots of other content coming out surrounding Elevate. Well, keeping things in the Diligent family, Dottie, you have a great interview today with our colleague over at Diligent Market Intelligence.
Yeah, I was really excited to have a chance to talk with Jason Booth. He's the shareholder activism editor at Diligent Market Intelligence, and there was this report that they took a look at the group of companies that IPO'd in 2021. Of course, that was a huge cohort of companies. It was maybe one of the biggest cohort of companies on record. It was, I think, over 1,000 companies that went public all in that year. And we've had now a couple years to sort of look back and see how they're doing. And it's really pretty interesting. And so we're kind of taking a look at how that cohort is doing versus the cohort that came after it, which went from over 1,000 companies IPOing in 2021 to about 175 that IPO'd in 2022. And it's kind of an interesting story. So I was delighted to have a chance to unpack some of the findings of that report with him and see what we could take away from that.
Let's give it a listen.
Joining us on the Corporate Director podcast today is our colleague, Jason Booth. Jason is the Shareholder Activism Editor at Diligent Market Intelligence. Jason, thanks so much for joining us on the podcast.
Oh, thanks for having me.
Well, Jason, I know you as someone who does these fantastic trainings every week for the team on what's happening in the world of activism. And so I was eager to have you on the show. I know that the Diligent Market Intelligence team is finishing up a study looking at IPO trends from a corporate governance perspective. So I wondered if you could tell us a little bit more about the history of that report and what were you looking to find out in this year's version?
Yeah, sure. Well, as you know, DMI tracks corporate governance characteristics of basically every US public company and increasingly companies overseas as well. So what we thought we would do is look at the IPO market, because as you know, corporate governance is central to the IPO process. In fact, the proxy statement of a public company going public is all about its governance, and that's really what shareholders look at when they decide whether to back a company or not. So we decided to look at the IPOs of a particular year. And in this case, we decided to go with 2021, which was a very active year, and identify sort of governance features and metrics that you know that of those companies, and see how they stack up against other already public companies, and then look at those companies and see how they performed over the subsequent years, over the 3 years, to try to identify sort of which governance features maybe had the most beneficial effect on their performance, both in terms of financial return, like return on investment, but also in stock market returns, return on total shareholder returns. So and Yeah, so we decided to pick 2021 because it was a record year, and what we found sort of provides some pretty interesting insights into the dynamics of the IPO market, and also into the financial performance and the governance practices and overall market positioning.
Well, Jason, I want to go into the details of the report, but before we go into that in detail, I'd love to ask, what made 2021 so notable in terms of IPOs? I think I know the answer, but why was that such a banner year? And what types of companies were going public?
It was a record year, and as the number of IPOs for the year and the amount of money raised, it was a standout year. We had 1,026 companies in the US go public,
Wow.
raising over $100 billion. And it was sort of a reset from the pandemic. We had obviously things dried up in 2020, and then a combination of the reopening of the economy, a cut in interest rates because in response to the pandemic, and particularly a excitement about technology companies and healthcare companies naturally, which rather a spin-off of the COVID pandemic. And in fact, technology companies and healthcare companies were 47% of all companies that went public in 2021. But another aspect of 2021, which is worth noting, is the SPACs, the special purpose acquisition companies, which are basically blank check companies set up to go basically to go public and allow an existing entity to go public, but without many of the requirements that are needed for traditional IPO. And we had, let's see, we had 631 SPACs that went public in 2021, and raising good deal of money, which I do have here. So 2021 was this particularly standout year. But I should note that since then, it's cooled off dramatically. And I think that's another reason it's interesting to look at 2021, because what's happened since. In 2022, we had a significant drop in the number of IPOs. We dropped to 175, with only 7.7 billion raised, compared to 100 billion plus the year before. And that excludes SPACs, but they also saw a dramatic drop off and continue to drop off. And the various reasons for that: the economic environment, uh, the increase in interest rates more recently, a slowdown in the private equity market, where money that might have been used to bring companies to an IPO hasn't been there, so to speak. So and that's a cooling we've seen, continue to today. So
That's really interesting. I'd love to ask you. I mean, so if I'm understanding what you're saying correctly, in 2021, more than half of the IPOs were with SPACs. Is that true?
yes, that would be correct. Yes.
And that seems to be a big change from where we are now. What were some of the other big takeaways from this year's edition of the report? Because I'm eager to hear sort of what you learned about these companies that went public in 2021.
Right. Well, first of all, looking at the companies that did go public, they do have definite differences than the already established companies. They tended to have smaller board size and a higher level of independence, which makes sense. CEOs have an average tenure of 5 years, typically hold a significant stake in the company of greater than 1%. The majority of the board have classified boards, I mean, they're staggered, and a minority of them, a significant minority, have a controlling shareholder. And when it comes to ESG and social trends, they tend to be on par with the rest of the market. And but there was a couple of other interesting things. We took away, for example, return on capital, which is the money that basically companies, initial investors make in a company over the longer term. We found that elevated board independence, controlled company status, and higher realized CEO pay had a positive influence on return on capital over the last 3 years, which maybe highlights the value of a balanced governance structure and in optimizing the capital structure. We thought that was a very interesting takeaway.
So how have those companies done since going public? What's the difference between this cohort and maybe other years that you've looked at? I mean, they have a greater board independence, a little bit smaller boards, more control status. How did that matter? How did that manifest?
To put it in context, of the companies that went public in 2021, we have 777 remain public, which kind of makes sense. Depends. Many of those were SPACs, obviously, so many of those didn't survive. And another interesting point that we did find is these companies have gotten stronger, but not as strong as one might think. The average EPS, the earnings per share of these companies, when they went public, was actually the average was a loss of $1.96 on average. Since then, well, as of 2023, the average of these cohort companies is a loss of 0.33, so 33 cents per share. So what we're seeing is, many of these companies were money losing before they went public, but they have been improving over time, but slowly. And currently, I mean, this our most recent figure for annual results for 2023, but be interesting to see whether in 2024 this group actually goes into the positive. I mean, we'll be looking out for that, because one way to look at this report that we're doing is sort of as a report card on these companies, and something that we can do going forward, looking at future years to have a look. So it's interesting to see how this particularly company seems to be improving financially. And we did notice that there was relatively stable earnings growth compared to the broader market indices, which maybe isn't entirely surprising given the volatility of the economy in the last few years. But the market cap growth, but the stock market performance of the companies was generally lower than the Russell 3000.
So other than just being a really large cohort to examine, are there any other sort of specific governance characteristics about this group, about this cohort that correlated with strong stock market performance? Like, are there things that you're seeing stand out among this group that they did that are unique and special?
As we look at these numbers, we've come up with several trends. Now, of course, we have to continue to monitor these going forward. But what we found is this: classified boards. We found that when it comes to now, I'm going to talk stock market returns here. Having a classified board is negatively associated with annualized total shareholder return. So having a classified board seems to be detrimental to stock performance, at least since they went public. Average director tenure, the longer average tenure appears to have a positive effect on total shareholder return. And that's also interesting, given that shareholder activists, as you know, are often trying to push out and bring in new directors. But what we found, at least in the initial stage, is having a decent amount of time and experience on the board is beneficial to the stock performance. But we did alternatively found that there was a slightly negative association between having a CEO, the CEO tenure. So having a long-standing CEO is a marginal negative for the stock, which we thought was interesting.
But I'd love to have you say more about the classified boards piece and why you think that's negatively associated with TSR, because that's fascinating too. Like usually when a company goes public and they set up the classified board structure, it's kind of to build in some automatic opportunities for refreshment, which is often seen as sort of a quote unquote best practice. And I know that's always a tricky term to use, right? Because best practice doesn't always correlate with actual performance. And so why is it best? But I'd be curious to hear your thoughts about that. Like sort of what do you think is driving that correlation between the classified board structure and a reduction in TSR?
I think it has to do personally with two things. One is shareholder sentiment. I think there is generally a negative sentiment towards classified boards.
Why is that?
Well, having a staggered board, where you have different directors sitting at different periods, it makes it harder to change directors. It is seen by many, or some at least, as just an indicator of sort of weak corporate governance. It seems to be that a board that's classified, they're classified for a particular reason. It's a defensive reason. So, that, at least from a shareholder activist point of view, it's always a red flag. It's always something they look at and something they want to change. I also think, again, we're looking at IPO companies, and a lot of these companies, I think, start with staggered boards, and typically a company, if it has a staggered board and it's a relatively new company, they'll have a plan in place to remove it, to change that situation going forward. If a company doesn't have that in place, that can be seen as a negative.
So, Jason, I'd love to just kind of round this out by asking you, what should board members and senior leaders at companies be taking away from these findings, right? It's always interesting to look at these cohorts and see, what is correlating with performance and, what is happening, what are the trends, but what should they take from this? I mean, are there specific action items coming out of this report that you think we should be suggesting to boards and CEOs?
Well, there's a couple of things. To me, the biggest takeaway was that there appears to be, governance seems to have different impact on, return on capital versus stock market performance, which is interesting, I think, because people tend to either be looking at one or the other. If you're an individual investor or an activist investor or a pension fund, you're interested in total shareholder return. You want to see those returns. But if you're a long-standing investor, you're a founder, a private equity company that's put money into into a new company, uh, or you are just a long-term investor, then return on capital is more significant to you over time. So that's something I think we want to look into more, the difference in those two responses. But there was a couple of other things I thought that boards might be interested in. I thought one of the more interesting standouts was about say on pay. As new companies, they tend to have different sort of pay metrics. But what we found was that of the 2021 companies that in the most recent annual meeting, they actually had the highest approval rating for say on pay with 93, almost 94% voter approval. Now, if you understand just some of the debate over executive pay, that's significant. But however, when it came to getting support from proxy advisors, they actually were very low. They received 65% support from proxy advisory companies for their pay because they're using non-standard compensation arrangements, which is quite typical with a new company. But there may be more to that there. So I thought that was an interesting. There seems to be a sort of disconnect between the way that shareholders currently look at pay, and they seem to be quite accepting of it, at least this year, versus proxy advisors and maybe regulators. We don't know, but it'll be interesting to see going forward whether those two schools of thought come together, or whether shareholders start to align more with the proxy advisors on pay, or whether the proxy advisors align more with the shareholders, or maybe simply with these new companies over time, their pay systems will become more standard, and they'll receive more support from proxy advisors.
Well, Jason, thank you so much for joining us today and sharing some of the findings of the report. Where's the best place for people to get a copy of the report if they'd like to read more?
Diligent Market Intelligence. It is not published yet, but it'll be coming out in the next several weeks, and we'll be putting out notices to everybody to alert them to it, and they can just reach out to me or anyone at DMI.
That's great. Well, thank you so much for joining us on the show.
Thank you very much for having me.
We've been joined today by Jason Booth, the Shareholder Activism Editor at Diligent Market Intelligence. Jason, thanks so much for being here.
Thanks, Dottie.
So, Megan, I was glad to have a chance to talk to Jason Booth. It is interesting to kind of take a look at what happened to this cohort. And in many ways, it's just kind of a point in time, right? We had this big backlog when there was no IPO activity in 2020 with the pandemic and everything was kind of shut down. And then, so over 1,000 companies go public in 2021. A lot of them are tech companies. We're in the middle of the pandemic still. They see massive growth. And then, of course, the very next year, there's a huge correction where people leave their homes and are no longer panic buying online. And so a lot of tech companies really suffer. And I think we saw that very much in the average share price of this group. Some of them lost about $2 of value right after they went public. Across the board by 2023, the average loss was 33 cents a share. They've been starting to improve over time, but it's I'm just kind of thinking, how much of this was because they were a giant group and how much of this was just what was happening generally in the economy. And I wonder what's going to happen with the IPO market moving forward. I don't know if you have any thoughts about that.
Yeah, it's interesting. I remain, I put my market speculation hat on like I'm some fancy person here. I work at Diligent. But, people have been increasingly optimistic about the IPO market. And I think for the first half of 2024, things have been generally positive, but it's not like the floodgates have opened. And there's some recent research that came out this week by Renaissance Capital. They're looking at maybe 30 to 50 more IPOs the rest of this year, which would make 2024 a solid year. But I think given recent market volatility, the presidential election, I don't think we're going to see a boom anytime soon.
Yeah, that seems about right too. I think the other thing that was kind of interesting talking to Jason about was, what were sort of the governance characteristics that seemed to be most beneficial for the stock market performance of this particular cohort. And, there weren't any real blockbuster findings in there, but there were a couple of things that I thought were kind of interesting. And one was, as a group, this group of young companies seemed to have sort of ESG programs and DEI programs that mirrored far more mature companies. Some of the big blue chip companies that have been doing a lot of work in ESG and DEI for many, many, many years. And that was kind of interesting. And the other thing that was sort of interesting was that they found that there was a slight correlation between having longer tenured board members being good for stock performance and a slight correlation, a negative correlation between CEO tenure and stock performance. So the longer the CEO had been in place, the worse the stock performed, and the longer the board members had been in place, the better the stock performed. Now, I want to qualify that in a big, big way, because when I asked Jason, okay, what do you mean by longer and shorter? And really what that was looking at was 5 years. So if the CEO had been there longer than 5 years, the stock performance didn't seem to go quite as well. And if the board members had been there for less than 5 years, the stock performance didn't seem to go as well. 5 years is not that long. I mean, when we think about governance land, we're talking about board members that are there for 25 years. And that sometimes makes you a little bit of a target for activist shareholders, right? Because you've got these long tenured board members, and sometimes the argument is made, are they still relevant to the business model 25 years on? So I think one of the things that's important to keep in mind about research like this, and we say this all the time at the Diligent Institute, is correlation does not equal causation, and slight variations in data doesn't necessarily point to a long-term trend. So I think it'll be fascinating to see, how is this group of companies doing next year? I mean, one thing that's also noteworthy, of the 1,075 or however many it was that IPO'd in 2021, only a little more than 700 remain public today. So, some of them have closed down. Some of them have decided, we're going private. It's really kind of interesting. So we'll keep an eye on it. But yeah, I think, Megan, the IPO market often is one of those things that isn't necessarily predictive of much, but it is helpful to watch. And it is, I think, reflective of what's happening in the broader economy, and certainly reflective of the cost of capital.
Well, I was going to say, speaking of IPOs, my TV pick of the week, because we haven't had enough of those lately. Dottie, you got to watch Industry on Max. Have you? I just started season 3. I've been a fan for a long time, but season 3, episode 1, charismatic founder, ESG, IPO, all of the things we've talked about today. It's a silly, silly little drama, but it's a lot of fun. And I love when shows talk about corporate governance.
Yeah, you know what? I'm glad you reminded me of that one, Megan, because I think I watched part of the first season, and then I think I might have got sucked into Ozark and sort of lost interest in almost anything else until I went through Ozark, which is such an incredible show. But yeah, no, you're right. Industry, very interesting show. I want to go back and watch more. Maybe I'll try to do that a little bit over the weekend, and we can come back and talk about it in the next episode.
Love it. Love it. I think we all need a little levity in today's world. And so nothing better than a juicy show about investment banking.
We are such dorks.
Yes.
All right. Well, Megan, that wraps up another episode of the Corporate Director Podcast, the voice of modern governance. We'd like to say a few special thank yous. First and foremost, to our colleague Jason Booth at Diligent Market Intelligence, podcast producer Kira Ciccarelli, the team at Oxenfree for making this podcast a reality, and most especially Diligent Corporation for sponsoring this show. If you like our show, please be sure to give us a rating on your podcast player of choice. You can also listen to our episodes and check out Inside Today's Boardrooms, presented by Diligent Institute, a weekly web show covering best practices for today's corporate boards and committees, by going to diligent.com/resources. Thank you so much for listening.
You've been listening to the Corporate Director Podcast. To ensure that you never miss an episode, subscribe to the show in your favorite podcast player. If you'd like to learn more about corporate governance and tools to help directors do their job better, visit www.diligent.com. Thank you so much for listening. Until next time.